Most people don't know about this so much because they just see the press release and they assume that's it. You wash your hands and you're done. But actually, because we're involved in the active management of the company as well afterwards, managing the debt profile also requires lawyers' input. So the CFO of the target company now says, hang on a minute, we've been bought out. We now have a massive amount of debt. And so that's where we come in to just help them monitor what they're doing with the debt, their compliance certificates, all of that stuff.
Welcome everyone to our first ever episode of 20-Minute TC. Really the goal of this podcast is to speak to lawyers and better understand what they actually do in their practice areas. There's a lot of gaps in my knowledge when it comes to commercial awareness, understanding what lawyers do. And so really my goal on this side is to help many more people understand the commercial side. So Mahesh, we've known each other for a few years. You used to work at TCLA. I'd love for you to just briefly introduce yourself.
Hi, everyone. Hi, Jason. My name is Mahesh. I'm a leverage finance lawyer at Freshfields, and I've had the pleasure of knowing Jason for a good number of years. He's always branching out into new things, and I'm very excited to be a part of this podcast. So thank you for having me, Jason.
Well, thank you for joining. So I'm going to dive straight in, as I promised. So you're in leveraged finance, and I know kind of bits about it, often in the context of private equity. We get taught a bit about what leverage is, but I'd love for you to just imagine I know nothing about finance. What is leveraged finance?
Okay. That's a good first question. And the truth is, I didn't really know much about what it meant until halfway through my training contract. So for those listening who aren't trainees just yet, they're already very advanced in the game. What I was going to say is, in simple terms, private equity is the game of making $1 into $3, essentially. And leverage finance helps them achieve that. That's the missing piece in the puzzle. So to break it down, I thought an example may be helpful rather than just cliche terms. So say you are interested in buying a company, and say that company is a McDonald's branch, and you value it at $300, for example, and you buy it for $300, you work on the branch, you improve the staff, the management, everything, the cleanliness, and it becomes a bigger business, and 4 or 5 years later, you sell it for $600. So your return on the amount of money you've put in is 2 times. So 2x essentially is the return. And in private equity, the term is called MOM, money on money, or MOIC, which is the multiple on invested capital. Now, leverage really helps to boost that returns because that's primarily why all investors come to private equity in the first place. That's why all of the major asset managers, pension funds, sovereign wealth funds come to invest in private equity as an asset class. And so how that works is, for $300, you put in $200 worth of cash and you borrow $100 from the bank. And this can be from investment banks or private credit funds. And we can talk a bit about that later. Now, fast forward 4 or 5 years later, assuming everything stays the same, assuming there's no interest rates to pay on the debt, you sell the business for $600, and now $600 over $200 of invested cash is 3x, and that's a lot more than 2 times returned. And so that boost of returns, which is a whole turn of leverage, as you say, it's a whole 100% extra in terms of additional return on your investment. That is where leverage finance as a concept comes in. And in private equity, the term is called LBOs, which are leveraged buyouts.
Amazing. Yeah, thank you for the financial example, which is always helps to bring it to life. So you're talking about this in the context of private equity. Does that mean the clients are exclusively private equity clients that come out to your team and are looking to raise leverage finance?
It's a good question because the clients that we interact with also dictate the kind of everything, right? The lifestyle, the kind of advice that you give, the kind of actual documents you work on. And yes, you're right. The core client base that we have would be private equity clients. I want to preface that by saying that the world of leverage finance is bigger than just private equity clients, because we have to remember there's also the lender side of the story when it comes to leverage finance. The borrowers are these private equity funds, you're correct. But on the lender side, you've got a whole bunch of investment banks, a whole bunch of private credit funds, and there are lawyers that represent them too. And so that's why there's two differentiating factors in terms of the kinds of clients you can have, borrower side or lender side. Within borrower side, yes, it is private equity funds, but it's important to understand why. Why is it not just any other company? And the reason is because the kind of buyout that we're doing is very risky. It's a highly leveraged investment. It is not Facebook or Google or any other massive company just trying to get a few extra $1 million from a bank. That would be investment grade loans. And that is a separate finance team altogether that tends to deal with those kind of transactions. Here, we're dealing with risky investments. We're dealing with highly leveraged buyouts, and the kind of documentation therefore also changes. And because it is a very niche and specialized area, I would say the vast majority of the clients that we tend to have are private equity clients, 80-90% of them.
Got it. And so if I kind of just sum up what I'm understanding there, so you generally act for the borrowers, which are the private equity clients, but also you're saying there's probably going to be another firm on the other side representing, say, an investment bank who's issuing the loan. And so does that capture that correctly, that the other side is typically an investment bank and you're negotiating with that side on behalf of your private equity client?
That is 100% correct. The borrower profile is typically a private equity sponsor. In the minority of cases, it might be a sovereign wealth fund. For example, GIC, lots of sovereign wealth funds are also, playing the private equity game and buying companies outright themselves or becoming a minority investor. In the rare instance, we do have massive conglomerate companies like Mars, for example, when they bought out Hotel Chocolat. That is also a leveraged buyout. And again, those are in the minority of instances, but 80% is private equity funds. Opposite us, we have Lenders Council. And yes, you're right, they represent either investment banks like Barclays, JPM, Deutsche Bank, for example, or they represent credit funds. So we've got KKR Credit, we've got Blackstone Credit, we've got Arcmont, HPS, the list goes on. There's a whole bunch of other private credit funds that are trying to enter the game as well on the lender side.
And how contentious is it? And what I mean by that is, what I expect from what I understand about private equity is they buy lots of companies. They're used to doing these leverage buyouts. Presumably, the banks are also used to working with those private equity clients. And so when you're, as a lawyer, negotiating on the terms with the other side, is that usually both of you trying to come to like a nice agreement you're both happy with? Can it sometimes be more contentious? How do you view that side?
I don't know what the impression is out there, but maybe the impression is that there's a lot of fighting that goes on between the bank side and the borrower side. I'd like to think that 90% of the time it is in fact incredibly harmonious. Here there is a vested interest to ensure that both parties win. And the reason is very simple, which is both parties are not walking away from each other after this for the next 7 years. That's how long the typical leverage buyout lasts, which is the debt facilities we provide will last for 7 years before the private equity fund looks to sell the asset and realize the investment and pay off the debt at the same time. So if you're being overly, contentious with your bank, so if you're trying to be overly sneaky, and try to get away with stuff without being open about it, the downside is that once the banks realize that after the deal is done, then for the entirety of the facility, you will be interacting with the bank basically every quarter, or with whoever owns your debt at that point, because banks tend to syndicate the debt. After they buy it, they tend to sell it on. Now, when it comes to getting permissions from the credit fund, when it comes to filing your compliance certificates, when it comes to seeking permissions from the lenders in the future to take on more debt, to change the debt profile, to refinance, if we have established a bad working relationship from the beginning, it's not going to be in our client's best interest anymore. And so as lawyers, our job is to act in the client's best interest. And by that logic, we have to toe the line very carefully between pushing across our client's best interest in terms of ensuring flexibility in the documentation, but at the same time, being realistic and pragmatic.
You said banks tend to syndicate it and sell it on. So I'm understanding the private equity firms borrowed money, the repayments are supposed to go to the investment bank, but something happens along the way. Where does those repayments go, or why does an investment bank sell that on?
It's a great question because this is not really publicly discussed as much, but there's a whole market, there's a whole world, in fact, which is called the world of syndication, where you would expect someone who lends money to just keep that on their balance sheet, i.e., if I've lent you money, Jason, I will just, keep that debt between the two of us. What investment banks do is, say, for example, say you've lent me, for example, say you've lent me $10, you can then go and sell that debt on to someone else. And if you manage to sell it for a higher price, you kind of essentially make the difference in between that. So you're a trader as opposed to being an actual lender. Now, why do investment banks have a role to begin with? Where did that concept come from of them coming in? Why didn't we just go directly to those who can buy the debt? Is for many reasons. Firstly, the debt packages are huge. So for Twitter, for example, just the sheer size of the debt package, if you go and research the deal, is just in the tens of billions of dollars, right? And most of the major buyouts tend to be underwritten, is the term, which basically means managed by the investment banks who are committing that capital to the private equity fund to say, don't worry, we will give you the money come what may. Go ahead and buy the company that you wish to buy. And taking a step back, this is important because the company that is being bought out needs certainty. We call this the concept of committed funds. They need certainty from the buying private equity fund that they actually have the money that they say they have to buy the company out. And so the investment bank comes in early in the process, underwrites the loan, and once that loan has, gone through, once it has been underwritten, they then go through the process at their own time, or they just syndicate it out to institutional investors, to pension funds. All kinds of debt investors exist in their client base. And we don't have as much of an oversight into that because that's a process that the investment bank runs by themselves afterwards. But that's one kind of financing. The other kind of financing is the private credit world, which is where you have a lot of private credit funds. Some of them are even owned by private equity houses, which is very interesting. You've got, KKR credit, you've got CVC credit. Most private equity funds have their own credit arm because credit is now an asset class in the sense that it gets a yield, which is the interest, right? And that's pretty high now. The Bank of England's interest rate is pretty high as well, and the margins on top of that just mean that the asset class can get a yield of anywhere from 10 to 13% every year, and that's a really good return. Private credit funds hold the debt; they're not selling it on to anyone else. That's not their business model. Their business model is to hold the debt, and because they're holding the debt, in the nicest way possible. They're a little bit more particular about what goes on in the documents because they're going to stick with it for the rest of the tenure of the loan. And so there are many different kinds of characteristics when you look at the loan products that private credit offers versus what we call as syndicated loans, which are underwritten by the investment banks.
So many questions. Bear with me. Okay, so I understood so I understand private equity firm wants to buy a company. The company being bought, so the target company wants to, well, the buyer wants the certainty of funds. The target company wants to know they can actually fund the acquisition. You mentioned that underwriting. I think I got a bit confused there. So, do you mind just explaining that part again?
Sure. So essentially, say the banks themselves, their business model is not holding debt on their balance sheet. So say if you have Goldman Sachs come in as an investment bank on a massive M&A deal. So they'll come in committing to provide 2 billion euros, for example, and they will negotiate a variety of terms and documents. And they are essentially underwriting it in the sense that if they aren't able to sell it on later on, they're going to still make sure that they have given you the funds that you need to complete your acquisition. So the money is going to come essentially from them. They can then sell the debt on to other institutional investors who want to enjoy the returns year on year of the interest that is being received on the loan. Because to give this example, again, I'll use an actual example. So say, Jason, you've lent me $10, right? Under private equity financings, you don't need to repay the loan until 7 years later, because the kind of facilities that we arrange for our sponsors is what we call as a TLB, a term loan B. The B stands for bullet, which means it's repaid at the end of the 7 years in one massive balloon payment, typically when the target is being sold on. And secondly, the term loan aspect means that it's really repayable after a certain term. It's not like a mortgage where every month you're kind of paying the principal and the interest. It could be a mortgage if you're doing an interest-only mortgage, by that logic. And so investors come in knowing that the only thing they're going to receive year on year is the interest on that debt. And depending on the investor's profile, they might prefer a more riskier investment, in which case it refers to, say, highly leveraged buyout. Right? When you look at the buyout of Asta and Morrison's, etc., they're pretty highly levered up, and the risk is that the companies may not end up repaying the debt. And for those loans, the interest rates tend to be very high. So if you look at some of the massive restructurings happening in the market with Altice France, for example, OQ Chemicals, this is all stuff that's online. If you go and look at the massive restructurings that's happening, all the debt held by these companies have very high interest rates because it's a risk-reward situation. The reward is great, but the risk is very high that they might default. They might go bankrupt. They might not end up paying the debt at the end of the day. And so investment banks underwrite 2 billion euros worth of debt. Who can afford to have the risk of losing or not getting 2 billion euros back at the end of their term? Not many people. And so they slice and dice the debt up, and that's what the process of underwriting involves, which means they take on that liability, and then they slice and dice it up. It's sort of like being a wholesaler, and they slice and dice it up, and they make a ton of fees in different ways, which is another whole podcast altogether. Maybe you can get a banker on this podcast to explain the sheer, different ways that an investment bank can financially gain from a transaction, which is typically, again, only when it actually happens. So they're incentivized to make sure that the deal works out well too.
It does. Yeah. Thank you for the explanation. I've heard of bullet payments when it's paid at the end, but I didn't realize that was a common practice in the space of private equity, which is very useful to know. The other thing I wanted to ask about, so you mentioned private credit. My very limited understanding of private credit is you have an increasing surge of private equity firms that are not just buying companies, but some of them have these separate parts of a private equity firm that's involved in lending. And it's a great way for the firm to make money, especially when some borrowers don't meet traditional lending requirements. Is that kind of what you meant? You said something about yield. What did you mean by that in this context?
The world that private credit operates in is typically the mid-market deal, just to put that in context first. And mid-market tends to be debt packages within the range of, say, 200 to 500 million euros. And that allows them to not take too much risk in any given credit investment. And the reason is simple, which is that with their fund, they can break it down to a variety of mid-market transactions and different targets, different deals, etc. Whereas if they took on too much, they have to hold the debt for 7 years. And can you imagine an entire credit fund's profile being, hinging on just one investment? It doesn't make sense. So firstly, they operate in the mid-market space. Secondly, the yields in which the yield that you're referring to is primarily referring to the interest that they receive year on year. And so it's how interests work for a borrower is it's typically a combination of two factors. It's a combination of what we call the base rate, which is just the interbank lending rate, which some people may have heard of Euribor. That's for the currency in euro. There is Sonia, for example, which is a sterling overnight index average. And so that's the base rate. And then there's something called margin. And margin plus the base rate is the total interest rate that is due by the borrower to the lender every quarter or every 6 months. And so the base rate is whatever the Bank of England chooses to keep. And say currently it's at 4%, whatever it is. And the margin would be 5%. And so combined, you've got you can say yield of 9%. And that is, negotiated usually between the borrower and the lender. And there's a whole bunch of negotiations that go on based on the leverage ratios, because you want to incentivize the borrower to also manage their debt profile. And so if over time the company improves and it grows and their earnings every year, we have the term EBITDA that I'm sure some people will be familiar with. If their EBITDA to debt ratio improves, then we have a margin ratchet, which means there's a step down every time the ratio becomes better, and your earnings to debt ratios become more, shall we say, lower and safe. Then the margin reduces, and it's an incentive for the borrower to work towards lower interest payments by improving the earnings and also ensuring that they don't take on too much debt that will make the ratios go up the ratchet. And so margin plus base rate is the interest, which from a credit fund's perspective is the yield that they get year on year.
This is very clear. Thank you. EBITDA, I hate ever learning that term, but I know it's something that can be tricky for people to get their heads around. I think the main thing I often think of is, just from your perspective, why do you think that is often used as the way to compare companies? Or you said EBITDA to debt ratio. What is the meaning of EBITDA, and why is it relevant?
I would recommend, for all those who are interested, I would recommend reading this article that came out about 20 years ago, and it's still highly relevant now. It's basically an explanation of the 20 reasons why EBITDA is actually not a very good metric. And so I agree with your point that there is no one size fits all. It's very hard to just slap something on a company and expect it to make sense, regardless of profile of company, size, jurisdiction, the kind of company. For example, certain smaller companies, right? They might have a recurring revenue as a better metric of the firm's financial success, because their EBITDA might be negative. There's all sorts of ways to look at companies. And what I would say is, from a lawyer's perspective at least, the EBITDA definition is helpful because it is pretty much one of many tenets of the facilities agreement that is negotiated, because it directly affects the covenants in the facilities agreement, the ratios as well, that those are the financial covenants, and the exclusions and inclusions in that definition is kind of what we as lawyers tend to come in and try and make it beneficial for their borrowers. So I'll just give an example of that. Say your earnings every year before amortization and all of that. Say you are planning to undertake an acquisition of another company, meaning the borrower is going to take on buy another company. In some ways, you can retrospectively add that back into your earnings, and that way you can improve your ratios and not be in breach of your financial covenants. And that all depends on the inclusions and exclusions in the EBITDA, which the definition alone can run for 3 to 4 pages long, just the EBITDA definition. I'm thinking of other things like synergies. So if you're talking about revenue synergies, synergies is less of a tangible concept per se, But including that in the definition will help to boost our EBITDA figure to that ratio to again allow us to pay a lower margin from a borrower perspective, right? From a lender perspective as well, I appreciate that there may be another there are many different metrics to kind of value a company or measure to the debt to earnings ratio. To that end, I will say that this problem is partially dealt with because without getting too technical, EBITDA to debt ratios aren't the only ratios in a facilities agreement. There are other concepts involved. We have what we call as a FCCR, which is a fixed charge coverage ratio. And again, that's a whole other ratio altogether. We have certain other ratios that are primarily based on, say, a company's recurring revenue as well. So we call that ARR financing, which is annual recurring revenue financing. So in bespoke situations, we do cater for these differences, but by and large, we do base it off the EBITDA figure. So that there are flaws within that model. You're completely right, but sometimes it's just the least worst option, shall we say?
Okay, I'm mindful of time, so I want to quickly shift gears to what a leverage finance lawyer actually does. And I'd love to know, in a typical transaction, what do you do from start to finish? Like, what happens when the client wants this loan, and what steps do you follow in the process?
Okay, so your question is from the beginning, what do we do? And I that is a very helpful starting point. And I will try and break it down into stages. So if we think about it in terms of three stages, one is pre-deal, one is during the deal, and one is post-deal. Okay, so pre-deal essentially refers to when a sponsor hasn't actually bought a target, but they're part of an auction bidding process and they're bidding for a target. And as part of that bidding process, they need to show that they have the money to buy the company. And part of that will obviously be debt. And so that's what we call as the commitment paper side of the deal, where we will draft the commitment letter, we will draft the fee letters with the various investment banks, we will draft we'll draft a term sheet, which is the initial high level breakdown of terms that we expect to see between the lenders and the borrowers, just so that eventually later on nobody says, oh, we want to change our minds. The term sheet will kind of be there as a base for future negotiations. And so that's what we call the commitment paper stage, right? Commitment letter, fee letter, term sheet. And when we move on to during the deal, which is when the auction process is successful, the private equity sponsor has become the winner of the bid, and they now come to us and say, "Hey, we're successful. Please, can you spend a good amount of time with the lenders now and actually hash out the documents, actually hash out these loan papers?" And that's broken down into a variety of papers. We have, I think the main one is the Senior Facilities Agreement. That's the SFA. That's what we typically work with. And the SFA would include a whole bunch of different facilities within it. So we might have a term loan B, as we've discussed today. It might include an RCF, which is a revolving credit facility for seasonal businesses, think holiday companies, hotels, etc., that need to just draw down extra cash just for 2 months before they repay it because of seasonal, cycles in their business. It might include, other more senior facilities. We call them sometimes PIK facilities, PIK, which is called payment in kind, which is an increasingly prevalent kind of financing that we see being put into capital structures, which refers to all of this debt profiles that the company has. And that's essentially where you defer your interest by adding your interest payments back to the principal, just to push back the repayment even further and increase the balloon of the debt that you have. So that's the Senior Facilities Agreement. The other core finance documents are the Intercreditor Agreement, the ICA. That's negotiated again between the borrowers and all of the lenders. Sometimes you might have 7 private credit funds, right, all taking slices of the debt. And so each of them would have to enter into this intercreditor agreement that governs the relationship that these creditors will have with each other when I say relationship, I don't mean literal relationship. I mean the kind of rankings and priorities that these lenders would have in the event of a default or insolvency. Who gets paid first, right? Who gets paid what? And which lender has particular voting rights or veto rights over certain actions that a company takes. All of these priorities and protections are governed by the intercreditor agreement. So this is what we call as the long form stage. There are certain what we call as condition precedent documents, CPs. You might hear a lot of junior lawyers complain about CPs being the bane of their existence. It's a very full on process because it's not worth to discuss it on this call, but basically there's like 10 to 20 documents over there, corporate authorization, security documents, etc., providing collateral for these loans. That's deal documents, right? Post deal, now we're signed, the money has moved hands, the private equity fund owns the target company, they're super happy, they're starting to run the business. Now we have post closing work streams. And that involves, most people don't know about this so much because they just see the press release and they assume that's it. You wash your hands and you're done. But actually, because we're involved in the active management of the company as well afterwards, managing the debt profile also requires, lawyers' input. So the CFO of the target company now says, hang on a minute, we've been bought out. We now have a massive amount of debt that we just need to stay on top of and manage to make sure that we aren't breaching any covenants, to make sure that we aren't, you know, for example, there are certain purposes for these facilities. You can't just use them to buy a private jet. You have to use them for working capital purposes, for future M&A. They just need guidance from time to time. And so that's where we come in to just help them monitor what they're doing with the debt, their compliance certificates, all of that stuff. We come in from time to time. They might even refinance the debt. They might say, hey, now the market's improved, the interest rates dropped. Can we refinance, just like how people refinance mortgages? Can we do that with our debt profile to reduce our interest payments? And that happens in the post-closing side where we still keep in touch with the target company CFO, with the sponsor to actively manage the asset and keep it viable and, in compliance with the facilities agreement.
Yeah, thank you. It's for me, it's so helpful to. It's like I can map out the steps now in my head, and I appreciate there may be differences in different deals, but it's much clearer to see that. You mentioned covenants. So my understanding of covenants is like things you can or can't do. And so what I'm imagining is this is a way that the bank wants to make sure that the borrower is doing certain things that's going to ensure it pays the money back, or not doing certain things that would affect that. Is that like a right explanation of covenants? And just also, what other terms do you see in the documents of the bank to make sure the borrower is going to pay the money back?
So I think the first question you're asking there is around the world of covenants. Okay, and the second part is what do banks do to make sure that the borrower pays? So to answer the first part of the question around covenants, we have incurrence covenants, we have maintenance covenants, there are financial covenants, and without getting again too detailed, I mean, maintenance covenants essentially says you should just maintain a certain debt profile, a certain ratio of EBITDA to debt, for example. Um, and when you have incurrence covenants, you're essentially saying when you want to incur more debt, when you want to actually draw down your revolving credit facility, or when you want to have an incremental loan, which is I want to borrow another 50 million from these lenders or other lenders, then you have to meet a certain set of ratios and tests, such as no default has happened, the ratios are within a certain leverage, multiple profile, etc. Then you have the other range of covenants. I think we discussed financial covenants, but we have another concept called positive covenants, which are it's actions you have to do, right? So we have, I mean, if you're asking about some technical terms, there are terms like cash flow sweep, which is where if you have extra cash in the business, then there's an excess cash flow sweep where the lenders will say, you have to apply 50% of all excess cash that you have towards prepayment of the loan. And that's one way in which to make sure that you are just, taking too much money out of the business. If you have, say, for example, you sold an asset, you sold a subsidiary, right? And there's a whole asset sale aspect to it as well, where if you do sell an asset, if it's below 5 million, keep it. But if it's above 5 million that you receive in proceeds, then, the excess cash flow sweep will apply, and you need to kind of apply that towards certain prepayment. Again, it depends which. Again, you'll pay certain lenders first, the senior lenders, and then you might pay the junior lenders afterwards, right? That's how the ranking works. So that's the world, I would say, of covenants. I would encourage anybody listening who is interested to research this online. I would say it's very hard to encapsulate all of them because they form easily, I would say, about 20 to 30% of a 400-page document. And so there's a whole world out there that I find very exciting, and I would encourage anybody to go and read up more about it, because that is the core of what we do as well.
That's it. We haven't talked about security, and my understanding is the private equity firm will buy a company, the debt is repaid by the company being bought, so that the target company. And so the other side of that is some of the assets of the target company will be used as security. Does that capture the security point? Is there anything in that space that is useful for people to know?
I think definitely. I think the reason I would say yes is because lately there's been a lot of chatter about what we call as LMEs, which is liability management exercises. And obviously, the debt that we have is a liability for the borrower. And lately, there's been, for anyone online who's listening and wants to read more about this, there's a concept, for example, called a J.Crew blocker. J.Crew might know is a clothing brand. And a few years ago, essentially, because what we provide as security for the loan, what we call as collateral, is actually a pretty important part of the lender's protections, which is access to this collateral should everything fall apart. It's kind of how a mortgage works, right? The banks have access to your house if you default on the mortgage. But what happens here is within the security documents, you will obviously have a whole bunch of negotiated provisions when it comes to, for example, material bank accounts. How material is material? Right, when it comes to obligations that the borrower has to keep informing you when it in the future has more security, when it has more bank accounts, all of these obligations, all of these, for example, even representation. Say if we are pledging intellectual property, we'll have representations that this IP is 100% owned by us, right? So that the security is actually valid when the banks are, valuing that against the amount of loan that the amount of loan that they're providing. Now, I'd explain J.Crew just because it's pretty interesting. Essentially, when you provide a financing, you provide security too. And what J.Crew did was they managed to take out the security from the companies that were pledged in the loan document to other companies. So the intellectual property, patents, trademarks, all of that, all of the value, the actual valuable asset, they managed to drop it down into what we call as an unrestricted subsidiary, which is a subsidiary that isn't a borrower or a guarantor to these facilities agreements. So it's in the ether. It can do whatever it wants to do. And they then managed to borrow more money from a whole new set of lenders using that as the collateral. And you can imagine the first group of lenders, they're not exactly very happy to hear this, right? And so lately there's been a whole market conversation around what we call as creditor on creditor violence, which is where creditors are acting in ways that are not very beneficial for the first group of creditors. And that's where you see the drafting changing. You see a lot more protections being built into the document, one of them being what we call as a J.Crew blocker, which is these are the entities. Once you provide a security of intellectual property here, you are not allowed to move it out of the restricted group, right? And again, to take it one more step further, what is a restricted or unrestricted subsidiary? It's defined as a restricted subsidiary is typically defined as a subsidiary that's a company that's owned by, wholly owned by the entity above it. And what people then did is they said, I'm going to give away 1% ownership Suddenly it's a partly owned company. Suddenly it's not a restricted subsidiary. And suddenly the guarantee and security is released and it's just, again, managed to come out of this group and I can get more financing from other banks. And that's what we call the Chewy blocker. So for anyone interested, research the J.Crew blocker and the Chewy blocker, and it'll help you understand a bit more about the role that guarantees and security plays in leveraged financings.
Fantastic. I have a very long list of terms that I've written down in my notes here. The last couple of questions I want to touch for you. So you're at Freshfields in leverage finance. I know in different firms, practices are structured a bit differently at different firms. Sometimes there's like a leverage finance practice area. Sometimes it sits within different finance teams. I know different firms have like lettering for their practice areas. Just how does leverage finance sit within Freshfields?
Sure, I think it's a good question again, just to understand from a business perspective where does leverage finance sit within the law firm business model as well. And every law firm has their own way of going about it. I would say for the major city firms, um, leverage finance would sit, well, at least in Freshfields anyway, it sits in between two main spheres. The first sphere is the private capital sphere, which is where we do everything and anything for our private equity sponsor clients. That's the entire gamut of actual M&A to financing to regulatory advice. All of that stuff is all geared just to the world of private equity. It also sits within what we call a special financing situations, which is where you've got, project finance comes in, corporate finance comes in, infrastructure finance, asset-backed finance. Again, there's a whole other, world to finance that doesn't involve leverage finance. And again, this team would sit with that because sometimes, as I mentioned, non-private equity sponsors might take on private equity-like financings within their business from time to time, and we will then work together with other financing teams. So that's how I would break it down. It sits between the PE space and the special financing situation space.
Last two questions there for you. I love your enthusiasm for leverage finance, and this is always really interesting to me when people. I can tell they really like the space that they're in. Why do you like leverage finance?
Yeah, I definitely like it. I wouldn't say I dream about it, but I definitely like what I do. And I think the reasons for liking what you do, especially for most corporate lawyers, it definitely a small part is the actual work. And in leverage finance, as opposed to, say, private equity itself, where you're an M&A lawyer, the work is a lot more, as you can tell from the short conversation, the language is just very different. And so to me, it felt like learning a new language. It felt that the kind of work that we do, which involves 400, 500-page long documents, it felt slightly nerdy to me, where you could just spend an entire day or two just getting lost in a book, essentially, which is what we write. And for all those wondering why it needs to be so long, some of these is publicly available. You can go and try and read one and just appreciate that when the amount that is being lent is massive. And so I like it because it fits my personality profile where it's nerdy, it's very highly detailed, and there's a linguistic aspect to it, which I enjoy. The last thing that I really like is the clients, which is when you meet people who work in private equity, who represent these banks, the bankers, the private credit guys, they're super brainy, they're super switched on. If anything, they keep inspiring us to kind of keep being better and keep this is a nice way of saying that they can be demanding at times, but they're clients that we have to always be on top of the market to be able to service them in a satisfactory way. And so it's a challenge that makes you feel that you're developing constantly. No day is the same. Every single day, there's a new development. It's not like some archaic law that you just kind of repeat again and again and again. Every single day, there's a new commercial consideration that keeps you on your toes. And that's why I like what I do.
Lovely. And the audience for this podcast is currently non-existent, but when it goes live, there will be an audience. And the kind of audience I have in mind is, yes, it's like aspiring lawyers, but also people that are future trainees, maybe even trainee solicitors that are trying to understand this space better, and especially the theory or the technical side of like what you actually do. I guess if you just had to give them the one piece of advice based on your journey so far, you're qualified, you're in this space, you're learning lots. What would you say to the audience?
Well, what I would say to them is what actually I received in advice from a senior who I really look up to. And the advice is that there is no end where you actually, one day where you wake up and you say, I know everything, I'm the expert on this, and everything is now done. It's not like a module at university where there's a syllabus and a reading list. Here, every single day is a new day. Even the partners themselves are learning every single day and figuring out problems. Nobody has all of the answers at any given point in time. And so the advice I'd give is to keep learning. I myself I probably know 10% of what there is to know as well, right? So what I would say is to just not think of it as a means to an end where there's a certain amount of information you need and then you stop learning, but just realize that even the partners are always learning something new every day. And so it's really a journey here where every single day you learn something new. You don't feel like there needs to be an end in sight where you attain a certain level of knowledge, and that's the end of it. It's a lifelong process. And once you develop that habit, then everything else tends to take care of itself.
Thank you very much, Mahesh, for being the first ever guest of this podcast, and entertaining me with your knowledge of leveraged finance. I think this is really helpful. I mean, I have been writing about leveraged finance, and I also learned so much just from this one episode. Thank you so much for coming on, and I hope to have you again soon.
Thank you very much, Jason. Really appreciate you having me on this podcast.